For his hits Hungry Eyes and All By Myself, has died at the age of 74. Mr. Carmen's wife announced his death, saying his music will be his lasting legacy. The singer rose to fame with the pop group The Raspberries before establishing a solo career. The song Hungry Eyes featured in the film Dirty Dancing, of course, with Patrick Swayze. All right, plenty more to come. Coming up next, Business Live with Ian King. Ian's going to be speaking to the Competition Watchdog about why pet owners could be paying too much for medicines and prescriptions.
The top business stories live from the Sky News City studio. Competition Markets Authority says pet owners could be paying too much for medicines or prescriptions. I'll be speaking with its chief executive. Earnings growth slows, raising hopes that the Bank of England may soon be able to cut interest rates. Plus, the government to give the green light for new gas-fired power plants to improve energy security. Good morning, this is Business Live with me, Ian King. The Competition and Markets Authority is to launch a formal investigation into the UK's veterinary services sector after a review highlighted concerns that pet owners are not getting a good deal. Well, the competition regulator, which began the review last September, said today it had received an unprecedented response from the public and veterinary professionals, suggesting it was right to look into the issue. Among the CMA's concerns are that consumers may not have enough information enabling them to choose the best veterinary practice or the right treatment for their needs, and that pet owners might be overpaying for medicines or prescriptions. Well, in response to the CMA statement, some of the biggest providers of veterinary services have issued their responses, including Pets at Home, which told us us, we are incredibly disappointed the CMA's findings today do not fully reflect our unique business model of locally owned vet practices. Whilst our brand is national, veterinary practices are led by individual entrepreneurial vets who have clinical and operational freedom. But joining me now is Sarah Cardell. She's Chief Executive at the CMA. Sarah, very good morning to you. What makes you think there is a lack of competition in the sector?
So in the UK, there are around 16 million pet owners, and this is a market that really matters. That's been reflected in the unprecedented public response we've had since we launched our initial review back in September last year. We had over 55,000 responses to that initial review. Now, we have heard from professionals within the sector about some of the pressures that they're under, but we've also identified three broad areas of concern that we believe require full and formal investigation at this stage. First is around access to information. It's really difficult for many pet owners to get access to clear upfront pricing information about treatment options, about prescription fees. We're concerned that many pet owners may be overpaying for medicines. But second, we're also concerned about how competition is actually working in this market. We've seen a huge growth in consolidation in the sector over the last few years. 10 years ago, around 10% of vet practices were owned by large corporate groups. That figure's now about 60%. And we're also concerned that some of the incentives these large corporate groups may have could be driving reduced choice and weaker competition. Finally, we're concerned about the regulatory framework itself. That dates back to the 1960s, and it may simply no longer be fit for purpose. So given the breadth of those concerns, we are now proposing to take forward a formal market investigation. We believe that's the best way to enable us to take direct action if our concerns are upheld.
You mentioned big corporates. I mean, what about this argument that people like Pets at Home are putting forward, that essentially they are local operators and in many cases they're bringing competition to local markets?
So we've seen a wide range of concerns. And if you think about access to information, making prices transparent and upfront, we've seen that 80% of the vet practices we looked at don't even publish basic price lists on their websites. For individual pet owners, when they're looking at treatment options, we're concerned that a lot of these large corporates have invested in sophisticated treatment options. Now, that brings many benefits, but it does mean that potentially pet owners are not being offered a full range of choice. They're not given access to some of the simpler, lower cost options that may better suit their needs. And we're also concerned that a number of these large corporate groups also own related services. So things like out-of-hours centres, specialist treatment centres, pet crematoria, and they may be referring business to those related businesses, which again could be reducing choice for pet owners.
You mentioned the transparency issue there. The British Veterinary Association has told us today they're already taking steps to improve transparency in the sector.
So we would encourage vet practices to take those steps. There's no reason, for example, why practices can't put basic pricing information on their website. We've heard a whole host of concerns about different issues about getting access to prices. So we think this needs a really full review to get a full sense of the extent of the concerns and potentially at the end of a market investigation, for example, enabling us to mandate the terms on which individual vet practices and those large corporate groups have to provide a whole set of information to pet owners.
Is your investigation going to take in pet insurance, which a lot of people seem to blame for inflating costs in the sector?
So our focus at the moment is on the vet sector itself, the provision of care to pet owners and their animals. Of course, the pet insurance sector is relevant there, but our focus at the moment is principally on the vet industry itself.
Is it too early to be talking about potential remedies?
So the reason that we are today consulting on taking forward a market investigation is it gives us the legal powers to do two things. Firstly, we can require companies to provide a full set of information to us, for example, about their business model, their business practice, their financials. But critically, it also gives us the power at the end of that market investigation to impose direct remedies. Now, it's too early to say exactly what those could be, but to give an idea, we could mandate information required to be provided to pet owners. We can require businesses to divest certain businesses or certain assets if that's necessary. And we could impose limits on prices, for example, around prescription fees. So there's a whole range of different remedies that we could impose at the end of this market investigation.
OK, Sarah, we're out of time, I'm afraid. Good to talk to you this morning. Thank you.
Thank you very much.
Some other business news stories for you now. And the UK government said today it will give the go-ahead to the building of new gas-fired power plants to improve energy security. It said that the UK faces a genuine prospect of blackouts without gas as a backup for renewable energy sources. The Department for Energy Security and Net Zero is also proposing a location-based method to determine how much consumers should be charged for the electricity they use, with those living close to power generators likely to pay less. Persimmon said today it will build more homes this year than it did in 2023, but warned it is expecting another challenging year. The UK's fourth largest house builder by stock market value said greater competition in the mortgage market and wage growth have contributed to improved affordability, but added that with interest rates expected to remain at current levels and a general election on the horizon, market conditions were expected to remain subdued throughout 2024. Well, pre-tax profits for 2023 came in at £351.8 million. That was down 52% on 2022, as Persimmon completed 33% fewer homes. The shares are currently off by more than 3%. And Domino's Pizza said today it expects to open more than 70 new outlets this year as part of an eventual target of having more than 1,600 stores across the UK and Ireland by the end of 2028 and more than 2,000 by 2033. The company was reporting an underlying pre-tax profit of £99 million for the 2023, to the year to Christmas Eve. That was up 200,000 on the previous 12 months. Domino's also announced it's paying £62 million to take full control of Shorecal. That's the largest Domino's franchise business operating in the Republic of Ireland and Northern Ireland. Now, earnings growth slowed during the 3 months to January, raising hopes that the Bank of England may soon be able to cut interest rates. The Office for National Statistics said average regular earnings, excluding bonuses, rose at an annual rate of 6.1% during the period. That was down from 6.2% during the final 3 months of 2023. Meanwhile, average regular earnings, including bonuses, rose by 5.6% year-on-year. That was down from 5.8% during the final 3 months of last year and was the slowest rate of growth since October 2022. The ONS also said the unemployment rate during the period rose to 3.9% from 3.8% in the final 3 months of 2023. Well, joining me now is Petra Tagg, Operations Director at Manpower UK, which has just published its own latest quarterly employment outlook for the UK. Petra, very good morning to you. Does this moderation in wages growth tally with what you're seeing?
Yes, it does. I mean, what we're seeing from a Manpower Group perspective is we are seeing that gradual decline and slowdown in wages. We are seeing less of the golden handshakes, the big sign-on bonuses. Obviously, that's complemented with the gradual reduction in the recession rates, which we're expecting to forecast at around 2%. So just seem to be starting to level off. So
would you expect this moderation in earnings growth to continue?
I do indeed. I think as we talk more about the market and what we're seeing in the latest trends, I think the reality now is that wages will start to slow down. We've got some positive increases in minimum wage coming through in April that will help offset some of those challenges as well.
It's a very mixed picture coming out of the jobs market just now. I mean, Recruitment and Employment Confederation told us this time yesterday they're seeing fairly weak conditions. Yeah. The PMI survey data suggests it's not quite so bad. Where do you see it right now?
Yeah, and indeed, I was listening to that interview yesterday. From our own data, we see that the hiring intentions are actually quite positive. When we look at our Manpower Group employment survey, we measure that on a percentage basis, which is actually showing plus 23%. If we look at where that was pre-COVID, it was about 10%. So even though it's slowed down since COVID, it's still showing, I would say, cautiously optimistic hiring expectations.
Are those hiring expectations pictures skewed at all by the fact that certain sectors are doing very well and others maybe less so?
Yeah, so we know that sectors are seeing different challenges. Some sectors are particularly seeing seasonal demand, but what we do see is that 8 in 10 organisations are struggling to find the right talent. So even if sectors are booming, their challenge remains to find that talent to bring into their organisations.
We heard a lot during the pandemic about labour hoarding. Is that still a factor?
I think organisations are playing different tactics. So some are retaining their workforce and looking at how they can, strengthen their workforce. Some organisations are also hiring for growth. So we know that small to medium-sized organisations, about 39% of those are actually looking to invest in future skills and talent in order to grow their organisations. Whereas some of the larger ones are slowing down a little bit and focusing on backfilling some of their outstanding vacancies.
Do you measure on-the-job skills training at all? Is that something that you look at?
We certainly are focused on skills and nurturing skills. We look at skills in two ways, in terms of finding the people with the transferable skills and also focusing on upskilling those individuals. Organisations today are looking for skills for the future, but we don't necessarily know what those skills look like. In many sectors, such as the green sector, the IT sector, we need people with different levels of skills that don't necessarily exist today. So it's really important that organisations recognise that and focus on those upskilling strategies.
Now, another hot topic, certainly among the politicians just now, is inactivity. I mean, the inactivity rate is 21.8% for the latest 3 months. Yeah. I mean, that's up from 20.5% pre-pandemic. Why has this become such an issue?
Well, it's really driving dynamics in the labour market. And if you look at some of those numbers, nearly 3 million of those individuals are on long-term sick. So we have to look at how we can encourage those back into the workforce. What's also quite alarming is many of that inactive population are 16 to 24-year-olds leaving the education system and not necessarily finding their way in the world of work. So we really need to look at how we can take them on that journey into the world of work, because arguably there are enough vacancies. If you look at the vacancies in the latest ONS data, 900,000 vacancies. Looking at that in comparison to the inactive individuals, you would argue that there is enough, work out there. But we have to close that mismatch of talent, that gap in the market.
OK, Petra, I have to leave it there, I'm afraid. Good to see you this morning. Thank you. Well, the pound slightly slipped on the foreign exchange markets following news of that easing in wages growth. Sterling currently off a sixth of 1% right now against the US dollar, currently off a quarter of 1% against the euro, single currency more or less unchanged against the greenback. On the equity markets, well, last night's falls on Wall Street were followed by a mixed session for stocks overnight in the Asia-Pacific region. The highlight is in the top right-hand corner of the screen there, the Hong Kong Hang Seng, which rose by more than 3% to hit a 3-month high. Meanwhile, in Europe, stocks this morning are largely positive just now. All the main continental Europeans up on some largely positive earnings reports. Talking points this morning include Leonardo, the Italian defence contractor, is up 4.5% in Milan. And that's on the news that it plans to invest more in AI. Well, here in London, the FTSE 100 is also in positive territory. In fact, that is close to a 3-week high right now, up by nearly 1.25% just now. A broad-based rally has been led by Hong Kong-geared stocks, including the likes of Prudential, Standard Chartered and HSBC. In terms of the fallers, well, the leading blue chip faller this morning is Persimmon, the house builder. I mentioned them a little earlier, currently off by 3.5%. Barratt Developments is off by nearly 1% in sympathy there. Outside the FTSE 100, the interdealer broker TP ICAP is currently ahead by 11.25%. That's on its results and confirmation it may spin off its data unit. To the downside, two stocks I've mentioned earlier in the programme. Pets at Home off 2%. CVS Group is off by 21%. That is on the CMA investigation into the veterinary sector. Another mid-cap faller to mention is Morgan Advanced Materials. That one's off 1% after full-year operating profits declined by nearly 17%. The oil price has rallied this morning. That's on news of that Chinese crude imports during the first 2 months of the year were up. A barrel of Brent crude will currently cost you $82.40 a barrel. That's up a little over 1/4% on the session. Well, joining me this morning is Sue Novka, Head of UK Equities at Schroders. Sue, good to see you this morning. Lots of results to digest. What's caught your eye? I mean, Domino's, I thought the results were OK, but the shares are off 7%.
Domino's are really good for the year and gave a lot of clarity on the future strategy, a lot of growth coming there. They've paused some of their investment in promotions at the end of last year and the first quarter of this year. So like-for-like growth really moderated from kind of mid-single digits down to less than 0.5% in the final 3 months of 2023. And that's caused people a little bit of concern. But what they've talked about is a fantastic store rollout programme, a consolidation of a franchisee in Ireland, which underpins growth, and quite a lot of promotional activity to come later in this year. So have to be patient. OK. Now, the biggest company reporting today is, of course, Persimmon. The shares are off slightly. I mean, it was a fairly steady-as-she-goes sort of statement. Yeah, the housing market has been tough for house builders in 2023, and there was confirmation of that. Persimmon had updated the market earlier in January with a trading statement, and I don't think the results today really gave much new news. So we're still on pause. It's all about interest rates later in this year.
Now, another one that has caught your eye is Hill & Smith.
Yes, that's a fantastic mid-sized company that's doing really well in the United States. It's underpinned by the expenditure of the US IRA, the Inflation Reduction Act, which is giving quite a lot of infrastructure that they plug into, whether it's electrification or whether that's roads. So it's confirmed that growth is really strong in the United States and pretty resilient in the UK. Those are the big markets.
Now, more broadly, this has been quite an exciting period for your space, UK equities. A lot of M&A activity, even in the last week. Wincanton, DS Smith, Virgin Money. Where do you see it going from here?
It's been pretty much a bid a day in the last fortnight. Not all of them will be consummated, and we saw pullback by Elliott for Currys. That leaves another player, Chinese firm, JD.com. But I think the valuation is really super attractive. So we're seeing in-sector consolidation from existing players in the UK market and a lot of activity from corporate buyers who can take out synergy cost savings.
I mean, the valuations, as you say, are cheap. Sterling's been on a bit of a roll lately. I mean, it's touching 7-month highs against the dollar. Would that potentially deter some US bidders?
I don't think so, because the absolute value of sterling is still pretty compelling. We're still at lows post Brexit and post the Trussonomics of September 22. So yes, we've come off some of those lows, but we're still down a long way from the 140s where we were probably about 18 months ago.
All right, Sue, good to see us. We're going to leave it there, I'm afraid. Thanks for joining me this morning. Still to come here on Business Live, I'll be joined by the Chief Executive of Genuit, the sustainable construction products company, as it reports a rise in pre-tax profits. Stay with us.
I'm Stuart Ramsey, and I'm Sky's chief correspondent. It's really desperate. That is actually the sort of pretty much hopeless column. We saw snatch squads going in, grabbing people.
You either live and recover, or you die.
Okay, so that's like a war.
That's the war.
We help you understand the world with us. Over the past 24 hours, the soldiers have been attacked on a number of occasions. It's really sending a clear message that Venezuela is eager for change.
Take you to the heart of stories that shape our world.
They were convinced the United States would become hooked. Well, they were right.
An enormous explosion has just come down.
It's not out of control, but they've withdrawn. It's so hot.
Emirates Premium Economy. Maybe one day all airlines will have seats like this.
Fly Emirates, fly better.
Welcome back. Now, if you're looking for a business seeking to reduce the impacts Britain's homes and built environment have on climate change, you'd be hard-pressed to improve on Genuit. The company, which older viewers may better remember as Polypipe, surprised the UK and European building and construction market with pipes, guttering, underfloor heating systems, air source heat pumps and ventilation management systems. Today, it reported a pre-tax profit of £48.4 million for 2023. That was up 6.6% on 2022. And with me, I'm pleased to say, is Joe Vorey, the Chief Executive of Genuit. Joe, good to see you.
Thanks for having me.
It's been a challenging year for the construction and building sectors. I mean, your top line was down, but you still managed to grow earnings.
Yeah, top line was down 5.7% in an industry that, by all accounts, that's probably a very good result. Different end sectors. I mean, we do face into new house building. It's only about 30% of our business. About 30% is RMI, which of course is really more about consumer confidence and willingness to do those home projects. Yeah, absolutely. And then commercial and infrastructure. Plus, we do have a growing international business as well. So that diversity has definitely helped us on the top line to outperform the market. And the bottom line, we've really been focused on simplifying the business, building a platform for growth, and investing in the future, because there's really the midterm sort of growth outlook is fantastic in the sector.
Yeah, you make the point in the statement. You've done a lot of new product launches during the year. What sort of things?
Sure. A couple of really great examples I'd love to share are we did a system, it's really a ventilation system that helps improve the ventilation in your house, but actually gets heat recovery so that in the winter you can get fresh air but without losing all the heat from your efficient system. Underfloor heating, we've actually innovated in the way that we can install underfloor heating to make it easier to go into retrofit and renovation projects. We've also entered, even in the plumbing business, a new line of products which makes it easier, faster, and more secure to install with our Polyplumb Enhanced. So these are the types of things that you need to do in order to really meet customers' demands as they're trying to struggle with essentially the green environment and all the changes that we need to do to really improve the carbon footprint of the built industry, which is about 40% of the UK's carbon footprint, and to essentially help us adapt to climate change.
Now, inflation has obviously been a big topic over the last 12 months. Apart from people, your main cost, I think, is PVC, am I right?
Materials, yeah, plastics in general would be about 50% of our spend, yeah. Now, about half of that, by the way, is recycled. We actually lead Europe in terms of companies like us, in terms of our recycled content. Clearly good for the environment, but it does provide a bit of a hedge on plastics. And we've committed to increasing that from 50% to 62% over the next few years, too.
And does that add a cost to the business, or is recycled material cheaper?
Typically, it's cheaper. It's also a bit more stable because really it's a labor cost as opposed to a raw material cost. So we find that it is a better part of our portfolio in general to do that.
Now, you own a business called New Heat, which is obviously a leading player in heat pumps. Are you concerned about the sluggish take-up in this country?
I see it as an opportunity. Right, if you think about it, across the UK, across Europe, we're actually in last place on the league table here in the UK, a few percent. Whereas the Scandics are actually quite a bit ahead of us, near 70, 80% take up in some cases. So that's a tremendous opportunity. As we face up to the future home standard, which is coming into effect in 2025, it's going to essentially be driving a large portion of new house building toward heat pumps. In addition to heat pumps comes underfloor heating and that heat recovery ventilation we were talking about earlier. These are all really, really good solutions, and we expect to see very low uptake increase to a sizable part of the market, which allows us to grow no matter what happens to the housing market. Plus, of course, we're about 20% down on the broader construction end markets that we face. That recovery will help us. And then long term, continuing to grow and innovate into varying areas of more efficient houses, better stormwater management, blue-green roofs. There's really a lot to play for longer term.
You mentioned water management there. Operating margins in that part of the business are much lower than in the other two divisions. Why is that?
So they started from a lower point, a higher material content, right? And certainly during the downturn, we saw a bit of price pressure on the materials there. What we've been able to do is focus on improving that business, though. And actually, as you might have noted, that division actually increased substantially, about 200 basis points up this year alone. We've committed to a long-term target getting to 15% plus. So we still think there's a lot we can do structurally to improve that business.
And very briefly, Joe, you're trying to diversify away from the UK, which is currently 90% of sales. Where will that be in 5 years' time?
It's a good question. Just to clarify one thing, we like being in the UK market, especially coming from the base we're at now. But definitely, we've said that you wouldn't be surprised to see the business at 20 or 30% or more international in, 5 years plus, both organically, plus perhaps with some more great acquisitions like we've done in the past.
And that'll be mainly mainland Europe that you diversify into?
It's the closest market, right? But there's some structural similarities to parts of North America as well. But that's probably our main focus.
All right, Joe, good to see you this morning. Thanks very much indeed for coming on. I know it's a busy day for you.
Thanks for having us. Appreciate it. Thank you.
That's it from me. I am back at 4:30 with our afternoon edition. Hope very much to see you then. In the meantime, do stay tuned. Coming up after this short break, it's Kamali Melbourne back with you. Thanks for joining me this morning. See you later. Cheerio.